The broadcast is now starting. All attendees are in listen-only mode.
All right, good morning, everyone, or good afternoon. My name is Jimmy Wu, your host for today at Function Point. Right now it is 11 a.m. Eastern time, so we're just going to give it about another minute or two for all the straddlers to come through. So if you can stay tuned, hold your horses, grab your cup of coffee or warm it up or have a bite.
No, no audio.
Oh, and then we'll get started.
Nope, can't hear you. Problem, so hang tight for just a second.
Oh, can you hear me now?
Now we can hear you.
All right, awesome. Sorry about that. It seems like with all the bandwidth that we're demanding from web meeting tools, they seem it's been disconnecting a little bit more recently. But welcome everyone. Thank you for joining. I want to let you know we're gonna give it it's right now 11:01 Eastern time, so we'll just give it 1 or 2 more minutes for all the straddlers. I see quite a few people are in the process of joining, so stay tuned and we'll get started in a minute from now. So grab your coffee, grab a snack, but stay tuned.
You're off to my sort of right eye, so I can still see you. So if my audio cuts out, wave at me because I'll just keep talking. So, all right.
All right, all right. I hope everyone has their cup of coffee or has some snacks beside them for this webinar. Thank you all for joining. My name is Jimmy Wu. I'm the Director of Sales and Marketing at Function Point. So thank you all for joining, and I'm very, very happy to have Drew from Agency Management Institute, or AMI, joining us today to go through a lot of the best practices and how an agency at this time during these unprecedented times, how you should manage some of your numbers so that we all can get through this together. Just a few housekeeping items before we get started. First off, in your GoToWebinar control panel, there is a questions tab. So throughout the webinar, if you do have questions, please do type them in. We'll try to get through as many of them as possible. We will have a Q&A session at the end of the hour try to get through as many as possible. Please note that we will be recording this webinar and be sharing it to you, including the slide deck, and we will be emailing it to you at the end. So please, once again, in the GoToMeeting control panel, there is a questions tab, so feel free to ask questions throughout. But let's get this roller coaster ride started. So if you joined our last webinar, we did discuss a lot of the reporting insights like staff utilization, efficiency, agency profitability, and how to pull those numbers. But really a lot of questions came up afterwards about, what are the metrics an agency should strive for? How should an agent, as an agency owner or a finance person, how can I manage the business, especially during this time? So we're very happy to have Drew here with us. He is from Agency Management Institute and has over 30 years plus experience in advertising with his own agency as well. So Drew, welcome. Thank you for joining us.
Thank you so much. My pleasure.
All right.
All right, you guys, let's get started. All right. So first of all, thanks to Function Point for inviting me. They've been a great partner to AMI for a long time. So I'm happy to do this. And I'm also happy to answer any questions. The last slide in the deck will have my contact information. So if you think of a question tomorrow, that you should have asked today, feel free to reach out to me. I'm happy to answer your questions. So here's what I want to cover are some key financial metrics to help us navigate out of this storm and into safe waters, how often you should be monitoring those metrics, and how to fix any metrics that are out of alignment. So that's a lot to get through in 45 minutes. So I'll try and be as efficient as possible. This is all stuff that we teach in some of our live workshops, but I pulled what I thought were some of the most important things for you to be thinking about as we come out of the lockdown that is happening all around the world and get back to trying to get back to business. So let me tell you a little bit about AMI first, in case you're not familiar with us. So again, as Jimmy said, my name is Drew McLellan. I've owned my own agency and still own my own agency. We're 25 as of the year 2020. And about 15 years ago, I purchased what is now AMI. So for the last 15 years or so, I've been coaching other agency owners how to run the business better. So I believe that most agency owners, and I certainly was a great example of this back 25 years ago, most agency owners are accidental business owners. We're great at something on the client facing side, but all of a sudden, somehow we ended up owning an agency. And now we're like, wait a second, there's a whole other side of this, the business of running our business that is challenging. So we serve several hundred agencies through that lens. We do workshops, we do coaching. What we're best known for, excuse me, are the agency owner peer groups. So think of a Vistage group or even President's Club. Only everyone around the table is an agency owner. And we have live where we get together for 2.5 days in the spring and 2.5 days in the fall. And we have virtual versions of those. Happy to say in the last recession, we did not lose one agency. Also happy to say 100% of our agencies have been PPP funded because we've been just pummeling them with information on how to get that done. Many of you may be familiar with us through the Build a Better Agency podcast, which has been around since 2015, and we do other stuff. So there you go. All right. Before I get into the financial metrics, I did want to point out that we have been pulling together agency-specific resources related to COVID. So all kinds of data on how clients who market through a recession navigate through that recession better, all kinds of facts and figures for you, and you can grab them at agencymanagementinstitute.com/COVID. And no email sign in, no whatever, just go take what is helpful to you. All right. All right. So I think it starts with figuring out where is your agency right now. So if you look, for many of you, when you started the agency, you were at the friends and family stage where it might have been just you or you and a coworker, and you were basically servicing your friends and family. And about 20% of agencies never outgrow that size. And by the way, there's nothing on the spectrum that is better than or worse than another. It's just you understanding where you're at. So I'm not advocating for one spot or another on the chart. It's just you knowing where you're at. Then after you've served your family and friends and kind of worked your Rolodex, if you will, for a while, then many of you get your first big client. And that big client is a huge portion of your billing. And that client we call a gorilla client really dominates and dictates how you run your business. And as a result of that, your business begins to morph to serve the gorilla. And about 50% of all agencies are stuck in, they've got one giant client and then a bunch of little clients around that giant client. Then some agencies are able to attract another client of significant size. And so now they're stepping away from just getting business through referrals, which is sort of at the gorilla stage. And now what they're doing is they've got a couple larger clients. And what they do is what I call feast or famine biz dev, which is as soon as something gets slow or soft, they go into panic mode and they do a whole bunch of biz dev development. And then they land a new client, and then they're so absorbed onboarding that client that they stop their biz dev for a while. And then when things slow down, they again scramble out the biz dev tools, and they just sort of do this feast or famine cycle. And another 15% of agencies get stuck there. So you can see that we're at 85% of agencies are in those first three sort of buckets, if you will. And then after that, some agencies decide to specialize. and they niche down in some way. Maybe it's an industry, maybe it's an audience, maybe it's a deliverable, and they start, because of that niche, they start to work on a consistent biz dev program, which keeps their sales funnel full. And those are the agencies, frankly, right now that are surviving better through the crisis. And a subset of those folks really become the known expert in their field. So they are the casino agency. They are the fill in the blank agency. They are one of the top 5 Hispanic agencies in terms of understanding that audience. So that's the less than 5%. And for those folks, the way biz dev changes is that they actually, business starts coming to them. Right fit customers start coming to them because they're a known expert. So as we start this conversation, I just want you to sort of pinpoint where you're at in that spectrum, because it'll have impact as we talk some more. So, all right. So let's talk about some financial metrics. So I'm hoping that many of you are familiar with the term adjusted gross income, or AGI. And that is the money that we have to spend on salary, overhead, and hopefully there's profits left over before taxes. So I want to make sure we're all talking about the same numbers. So gross billings, your gross revenue, however you want to call that, is really a vanity number. Our industry talks about that vanity number all of the time. So when you read the trade pubs and they talk about an agency that's, you know, a $3 billion agency or whatever, understand that is a gross billings number. And it really doesn't actually pertain to running the business. The only real number that matters to an independent agency owner is adjusted gross income, because the rest of that money, the rest of the money that's in gross billings, you're just the bank for. So you buy $1 million of media for a client, you take in $1 million, so that shows up on your gross revenue, but 85% of that number goes right back out the door. And so that's not really your money to spend. It's not your money to plan on. The commission part is, right? And that drops down into AGI. But the gross billings are not relevant really for us. So the number I want you to really focus on when you run your business is adjusted gross income. I don't care what your revenue is. If you want to shoot for a number because it feels good to have to hit the 2 million mark or the 1 million mark or whatever it is for you, that's fine. But the number that matters is AGI, right? So I've just talked to you about revenue. So what we're going to do to get to the adjusted gross income is we're going to take our gross revenue, all our billings, all our sales, and we're going to subtract our cost of goods sold, including any 1099 people that we employ, any contractors, our cost of goods sold. And the reason why they are cost of goods sold, and by the way, you may have to argue with your accountant about this because this is very specific to agencies. But the reason why they are a cost of goods is because none of you send money to your freelance graphic designer if they're not doing client work for you. They absolutely are tied to the goods that you sell. So they are not a part of your AGI. So gross revenue minus cost of goods gives us AGI. So how do agencies spend their AGI? And this is the first metric and maybe one of the most important metrics of running your business, COVID or not. Ideally, it's 55% of your AGI is spent on loaded salary, so salary and benefits, no more than 25% on overhead, which leaves you 20% profit. And when I meet a lot of agency owners, they'll say, there's no way I can make 20% profit. And I'm telling you, yes, there is. So I see the financials of the agencies that we serve. And I'm telling you that on average, what I think of as an AMI agency, somebody we serve, is between 16 and 17% of profit. So they are hitting those numbers. You can do it. You just have to manage to these numbers. So the average, however, across the world is about 63% of salary and benefits, 27% overhead, which only leaves 10% profit. All right. So the bottom line, for some of you, you may live in a market where your overhead isn't that high. You may live in a smaller city. You may not pay a lot of money in rent. So ideally, your payroll, loaded payroll, and your overhead should not be greater than 80%. And by the way, that includes paying yourself a salary of about $130,000 because of, if you're in the US, because of Social Security, FICA matches and things like that. But ideally, your payroll and your overhead should not be greater than 80%. I will say this, in COVID, it's okay to decide that you're not going to shoot for 20%. This may not be the year for you to do that. You're managing your expenses as tight as you can, but you absolutely have to be looking at this 55, 25, 20 to make sure that if it's not 20, it still stays in the black. You have to manage to that. No agency should go in the red because of COVID. We have different decisions to make if we're going in the red, all right? So again, your EBITDA or earnings before taxes should be 20% in a normal year. What I'm saying to agencies now is even if you're at 5% at the end of 2020, I would call that a success. Now, some of you are busier than ever before. Some of you are hiring. Some of you are landing new clients. So for you, you absolutely should be shooting for 20%. But for those of you that have taken a hit because of COVID, that have lost AGI, lost clients, clients have hit the pause button, for you, you may say, you know what, my whole goal is just to stay in the black, and I'm going to manage to a different number for 2020. But coming into 2021, I want you to go back to 55, 25, 20. All right. So again, keep it super simple. Most agency owners do not love math. They are not accountants or CPAs. And so this is a metric that all of you can measure and monitor. And I know you can do it inside Function Point. So let's talk about some employee metrics, because honestly, this is where you're going to make it or break it. So when I think about the agencies and how you are all going to survive through this, it is the employee metrics that are going to determine that, because this is the one place where we struggle to make the right decisions for the right reasons, because they impact other people. And I would be sad if this was ever an easy decision for you, a decision to reduce your staff or do a pay cut or however you're going to handle that. But it is a decision that we have to make, especially during this time of COVID. So let's talk about your AGI per FTEs. And you can see why AGI, you have to understand AGI, because all of the metrics I'm going to talk to you about are AGI specific, okay? So the first one is, in a normal year, you should have $150,000 of AGI per FTE. And so that's as simple as dividing the number of employees that you have and figuring out exactly where you are in AGI. If you are at $100,000 of AGI per FTE, you probably are barely holding your head above water. There's probably very little profit at the end of the year. If you are at 150, you're at 20% profit. So you can see the sliding scale here. And you can see that, that you can sort of decide where in that scale you want to be, and you can make adjustments to that. So again, if you're not shooting for 20% profit this year, but you are shooting for some profit, you're shooting to be in the black, maybe you want to be at 110 of AGI per FTE, okay?
Hey, Drew, we have a question that came in a couple minutes ago. Quick question. They wanted to confirm, are these target percentages, these target percentages are of AGI, is that correct?
That's correct. Everything is about AGI. So, because that's the money we get to keep. Keep in mind, gross billings, a lot of that money just passes through us like a bank, but AGI is the money we have earned that we get to keep to run our business. And for most of us, for all of us, the big expenses are our people and our overhead, and hopefully profit left over for profit sharing, taxes, all that sort of thing. All right. So just to give you some perspective, when I look at different kinds of businesses, for some of you, hitting the 150 of AGI per FTE is easier than others. So digital shops typically can charge a premium for their services, and so they don't have any trouble with that. If you are a media buying shop, as your commissions are being squished, if you have not come up with other ways to be compensated, then it's harder for you. And so many media buying and planning shops are closer to the 110. One of the things that we monitor is the industry as a whole versus our agencies. And our agencies are on average, again, at $142,000 per FTE. So again, if your AGI is 1.5 million, that means you should have 10 FTEs, so full-time equivalents. And I will tell you, this is probably the most violated financial metric in the agency business. Healthy times, tough times, doesn't matter. Most agencies are overstaffed, and there is a direct correlation. Many of you do a great job of managing your overhead expenses. Most agencies do a pretty good job of managing overhead. The place where we sort of go a little off the rails is the number of people. And oftentimes it's because your team comes to you and they said, I can't possibly take on another project. We have to have another, web dev person. We have to have another graphic designer. We have to have another writer, whatever it is. We can't possibly take on more work. And you don't have any way to substantiate or argue that. Well, now you do. You can check and say, well, you know what? Our metrics show that we don't have enough work to justify another body. So something else is broken. We need to look at other metrics to see where we're leaking money because we don't need another body. And in fact, if we hire another body, we're just going to leak more money out of whatever hole the agency has. All right.
A quick question came up. Would you include agency owners in that FTE count?
Absolutely. Everyone who gets a W-2, and every agency owner should get a W-2. So I know some of you like to pay yourselves just out of the dividends, but yes, whether you pay yourself just dividends, then you have to add the dividend dollars. But ideally what you're doing is, an agency's owner's compensation comes in two parts. Our W-2 income is our paycheck for the work we do as the CEO or the president or the director of account service, whatever role you serve inside the agency. The dividends or distributions you take are the reward you get for taking the risk of owning a business. Two different compensations for two different reasons. And if you're really running your agency well, you should be getting a healthy paycheck, again, somewhere around $130,000 as W-2 income, if you're in the United States, or a paycheck. And then you should be getting distribution or dividend income on top of that, which is the profits or the reward you get for owning the business. All right, so here's another metric that's really critical for us is billable to non-billable staff. At the most, 1 out of every 5 employees is non-billable. My definition of non-billable is 50% less billable, which means most of you listening, if you are the CFO or the bookkeeper or the agency owner, you're non-billable. So for every one of you that is not billing 50% or more of their time, then you've got to have 4 people who offset that. In many cases right now with COVID, people are not keeping the 1-to-5 ratio. They're going to a 1-to-7 or 1-to-8 ratio. And pretty much everybody who's staying on the team is billing a large portion of their time as the agency reduces staff and tries to service the clients that they still have to try and make up the deficit of the income that they've lost. So here's another super important metric. And I know, Jimmy, you were saying that you were talking in the last webinar of how people can find this information. So 75% of the agency's time should be billable. And yes, that includes all the non-billable people. So I'll show you in a minute how you calculate that. But 75% of all the time that the agency as a whole records in timesheets, and I'm not even going to get into the timesheet discussion. You all need to do timesheets. 75% of that should be time spent on things you can bill. And 60% of that time, so of all of the time, needs to be time that is actually billed to a client. Whether you bill by the hour or not, it's just basically the dollar equivalent of that time needs to show up on an invoice. So let me, I'm going to show you the math of that in a second, but the bottom line is for every agency, many of you are going to fall underneath the 75 and 60% ratios. And what that means is you're doing a bunch of work that you're not getting paid to do, and you're writing that time off. And if you could only fix one thing in your agency, COVID or not, if you could only fix one thing in your agency and you stop writing time off, and I've had agencies that have focused on this and we've done it, it's amazing what happens. They go from single-digit profit to double-digit profit in 90 days just by correcting the write-off problem. So how do you figure it out? You take the number of employees, so full-time equivalents. So again, if you have 12 employees and 2 of them are part-time, you would be 11 full-time equivalents. You multiply that by 1920. Why 1920? Because that's 48 weeks a year and 40 hours a week. So that allows for some vacation time, holidays, things like that. And that gives you your total number of available hours, right? So if I have 10 employees, I multiply it by 1920, I get 19,200, right? So then I have to have 75% of that time needs to be billable work, needs to be time code work that is billable, and 60% of that time needs to actually show up on an invoice to a client. And the way you can figure this out is you just look in function point and you see how many hours did we actually bill, how many hours were tied to a billable function code, and divide that by the total number of hours. And I'm showing you the old school math. I'm sure new school math does it in a different way, but you figure that out. And I will tell you in my example. So here we go. Let's say I said, okay, in our billable function codes, 8,750 hours were spent on billable tasks out of my 1920, which means that only 45% of my time, my agency's time, was, I even have a shot at billing. And odds are I'm not going to bill it all because we went over budget or other things. So, and by the way, this is sort of typical of an agency. So many of you, when you do this math, are going to clutch at your chest a little bit. This is disheartening to say the least. So many of you are going to realize that you are under billing. So your people are spending too much time on unbillable things. This is something you need to drill down into and figure out where they're spending their time. Are we not capturing time accurately? That may be it. They may be doing their timesheets wrong. Are we tasking them with too many committees and tasks and meetings that aren't billable? Do we have too many people? We just don't have enough work to have everyone be billable at the 75%. So lots of questions around this, but understand that this is a super important metric for you. So again, your goal should be 60 to 65% of all your available hours are actually billed to a client. Most of you do not bill by the hour. So I'm not saying change your billing. What I'm saying is figure out what that dollar equivalent is and see what you're actually billing. What your AGI is, and that'll tell you whether or not you're hitting that ratio.
Hey, Drew, we had a couple questions that came in regarding this. The first one is, would it be acceptable to treat one full-time person as being 0.8 FTE if they have supervisory duties?
No, it does. I try to keep all the math super simple, so you don't have to do anything. It doesn't matter how billable they are or not because you're including everyone, right? So if somebody gets a paycheck from you, they are in this number. So in my example of the 10 employees, right? That might include me, the agency owner. That might include the CFO. So 2 of those 10 might be unbillable. You still have to count them because the entire agency's billable hours have to cover the expenses of all of the employees. So do not cherry pick out the billable or unbillable. All you want to know is how many full-time equivalents do I have on my payroll, billable or not, and then you do this math.
Okay, and the second question was, in the formula you had, is the denominator based on the 40 hours per week or the total reported work time?
Yeah, so if people are working more than 40 hours, so again, this is sort of if everyone worked 48 weeks and it was 40 hours, right? So I'm using the perfect example, which of course no one is. So yours is total number of hours available. You can decide if you want to use the 1920 number, the 48 hours by 40, and say, look, if everyone worked 40 hours, this is where we're at. In some cases, people are working fewer or more hours, and that's just gravy for us. But what most agencies do is they actually do this based on the total number of hours that were actually logged. And the reason for that is it helps you see where you have inefficiencies. So you can choose to do either. My preference is that you would look at, okay, the total number of hours logged for this month or this quarter are this. How many of those hours were put against a billable cat code? And then that'll give you my percentage. So that's a more accurate number.
Great. And so does that mean you should really track time
All right,
to your vacation?
Good to go?
Yes, good to go. Just one quick question for myself, actually.
Okay, I'm going to keep going. All right, so now let's talk about some client metrics. So what is your client balance? What I mean by that is how do your clients show up in your AGI? Do you have a gorilla? And a gorilla, by our definition, is 25% 30% of your AGI, which is, I have some agencies that have a gorilla client that's 80% of their AGI. But when you have these clients that are that large, what that means is you have to have more cash on hand, because if they go away, you've got to have a bigger safety net to recover from that. So another couple client metrics I want you to be tracking are profitability by client. So what clients are we making money on, and what clients are costing us money? So I guarantee you, when you look at the profitability by client report, you will have a client or two that you are literally paying for the privilege of serving that client. It's costing you money to have that client. I promise you. If you've not looked, you're horrified by realizing that you're taking money out of your pocket and you are paying people to do work for that client, and you're not getting that money back, right? Also pay attention to profitability by job type. For many of you, you have some sweet spot jobs or types of work that you really make great money on, but you also have some where you lose your shirt over and over and over again. And it may be that that's your foot in the door. Maybe that's your loss leader. That's a business decision you get to make, but I want you to make it from an informed point of view, which is, I know that every time we do a website, we're going to lose money. I know every time we do a logo, we're going to lose money, whatever it is, and then make a business decision about whether or not you still want to do that. There is not a client or a job type where you should be happy with less than 10% profit, okay? So that's really the threshold. Again, COVID, you are probably going to make some concessions, but as we come out of COVID, and what I'm hoping is, if you're not tracking all of this on a monthly basis, which you need to be doing, if you're not tracking this, that you get in the habit now as you are working your way out of the COVID crisis, and then you keep the habit after this, and that you continue to track these things monthly and make business decisions based on them monthly. So let's talk a little bit about cash. The truth is that most agencies fail. If an agency is going to fail, it's because they run out of cash, not because it's a bad agency. And one of the things we know that happens in a recession is that clients start to slow pay agencies. So we are all in a position right now of being at risk because we could run out of cash. And so you've got to really manage your cash and your cash flow very diligently. And many agencies are doing this on a weekly basis. They are updating their cash projections on cash flow projections on a weekly basis because it's so critical. All right. So what does cash on hand look like? That's, if I said to you, by tomorrow at noon, I want you to have all of the cash on a table in your conference room. That's all the money that in 24 hours you could get. So for most of you, it's checking or saving. Some of you still keep a little petty cash in the office. You might have some liquid investments that you have in the agency. So that's your cash on hand. Now what I want you to do is take your total overhead. So that's loaded salaries and overhead, and divide it by 12. So that's your monthly nut, which many of you know what your monthly nut is. I'm not going to make any money, but this is how much money I have to have just to keep my head above water. And your goal is, whatever that monthly nut is, your goal is to have at least 2 months of that cash on hand. But if you have a gorilla, then you've got to have 4 months on hand. And I don't have time to get into it in this webinar, but we have a lot of strategies about how you should hold that cash, because if you keep it in the agency in the wrong way, then it gives you permission to overspend. And that's a dangerous thing. So for example, you know that you should let go of one of your employees, but you have money in the bank, you don't really want to have the conversation, and so you don't. So not only should you have cash on hand, but you need to have it in a way that it doesn't give you permission to misspend it, all right? So let's talk about cash flow projections, and I want to get through this really quick because I want to leave you lots of time to ask questions. So cash flow projection, which I'm hoping all of you are already doing. My guess is that, and Jimmy, jump in, but my guess is that Function Point will allow you to do this. But it's what milestones or completed projects will you complete and bill in 30 days, 60 days, and 90 days, right? So here's the money. Here are the jobs that I already have assigned project authorization for, and here's just the progression of that job and when we think we will when we will bill it, and then also when we will get paid, which I'll talk about in a second. Then what work do I anticipate selling? So who's in the sales funnel? And I think we're getting ready to close them. And when will we be able to start that work? in 30, 60, or 90 days. And for many of you, you milestone bill. So you might bill a client 25% or 50% at the start of a job. And then you have certain milestones in the project authorization where you bill them again. You need to note all of that. So in a normal time, when we are not in the middle of a recession, most agencies get paid within 45 days. That's sort of the normal cycle for agencies, 30 to 45 days. And in a normal time, you don't have to add this little piece to your cash flow projection. But right now, I think you need to be doing this by client and then factor in how each of those clients are paying their bills. And what is the average turn on their invoices? So for some clients, they may still be paying you over 30 or 45 days. And others, you're going to very quickly see, if you haven't already, that they're going to stretch you out for 90 days or 120 days. So what projects are underway? When are we going to close and bill them? When do we expect to get the money? What projects are we about to sell? When can we start billing milestones? When do we expect to get the money? And then how quickly are clients paying their bills? You lay that against your estimated expenses. So again, that loaded overhead, so salaries, benefits, and overhead expenses for 30, 60, and 90 days. And then you look at the net. So what is the net of my income versus my expenses for that 30, 60, or 90 days? And as long as that's staying in the positive, because again, hopefully you have some money in the bank, as long as that's staying in the black, you're fine. The minute that at 90 days, and then you should not be reacting to this at 30 days, by the way, you should be reacting to it at 90 days. The minute that starts to go in the red, you have some tough decisions to make. You've got to find a way to get it back in the black. So in normal times, you would just push to sell more, or you might trim some expenses, but many of you have already done all of that, which again means that you may have a difficult personnel decision to make based on the fact that your job is to not allow your agency to go in the red at all. Through all of this COVID, there's no reason why your agency can't be profitable through this if you manage to these numbers. All right. So I want you to take that cash flow and I want you to look at it. What was it prior to March 1st? So where were we chugging along prior to COVID hitting most of the world other than Asia? Then what do you think it is now, sort of mid-COVID? Because for most of the world, we're sort of in the mid-COVID stage. We're coming out of panic and going into containment, right? And I don't mean the disease itself, I mean economically. So where are we at mid-COVID? And then I want you to do something that's going to be really painful, which is now I want you to reduce the mid-COVID income, what you think you're going to get in the next 30, 60, and 90 days by another 40%. And ask yourself, do you still have cash on hand? Because if you don't, you are putting yourself in a precarious position. So we have seen clients just on a dime hit the pause button, and you need to be ready for that. You should always be able to weather a dip in income for 30, 60, or 90 days. So part of this is going to depend on how much cash you have on hand in conjunction with what you think is going to happen in the 30, 60, or 90 days. And if you can do that and you still are in the black, then you can start to breathe easy. You're in good financial shape and you are going to navigate through this just fine. But these are the metrics that matter. And cash flow, you should do weekly. All the others you should be doing monthly. And you should be doing it inside function point. And then communicating that with your leadership team, making decisions based on it, and moving forward, knowing with confidence that you're on safe and firm financial footing. So again, it's AGI 55-25-20. It's how many FTEs do I have per AGI? So $150,000 of AGI per FTE. How many billable versus non-billable people do I have? In good times, it shouldn't be more than 20%. Right now, it probably should be less than that. What is our billability and our utilization? What's my client balance look like? Is everybody between 5 and 20% of my AGI? If not, how do I fix that? What is my profit by client and project type? And my cash flow, can I sustain the agency? If you track these metrics, and I know there's a million other metrics you can track, but I'm telling you, if you track these metrics, COVID time, un-COVID time, doesn't matter. You will know very quickly at a glance how healthy your agency is, which means you sleep better, it means you make better decisions. It means you're making decisions based on data, not when someone rushes to you and says we have to hire someone or someone's not performing. You can look at this data and you will know how your agency is doing. Okay, so I'm going to go to questions. I'm just going to show you that on this deck, which you will get, you can reach me on a plethora of ways. So you can reach us at Agency Management Institute. You can reach me on LinkedIn. You can email me wherever you want. So, all right, what questions do you have for me?
All right, Drew, can you hear me?
Yep.
Okay, awesome. So just before we get into the questions, I want to let everyone know a quick reminder. In your GoToWebinar control panel, there is a questions tab. So this is your chance. Feel free to type in as many questions as you can. So let's go to the first one. This one's from Mitch. So when figuring out the cost of salaries, do you add the owner's perks, quote unquote, such as petty cash, car leases, things along those lines?
No, because that's going to show up in your overhead expenses, right? So anything that you have as a pass-through expense that you're able to run through the agency as a perk of ownership, which I'm all for, by the way. Internet at home, all that sort of stuff, absolutely should be as part of your overhead expense. So it doesn't need to go in the salary number. For you, it's basically what is on your paycheck and all of the deductions out of your paycheck. And if you don't take a paycheck, then look at what your distributions. So some of you just cut yourself a distribution check or a dividend check on the same day that everyone else gets a paycheck. If that's how you pay yourself, then you need to count that as inside the salary numbers.
Okay. Great, thank you. So the next question is from Ryan. Can you talk more on how to calculate profitability by client or by job type?
Yeah, so Jimmy, I'm assuming that they can do both of those things inside function point, right?
Correct, yes.
So do you want to answer that question if it's inside the tool?
Yeah, so sure. So with the profitability inside function point, when you manage your jobs, as long as you categorize your job types or client properly, for the profitability by client, you can always just pull up the client record, and under the job financials tab, it will give you a summary of all the different jobs you've done over a specific time frame, as well as the estimate, actuals, invoice, and also the cost. So the key here is to make sure that you are tracking the time diligently in function point, as well as making sure you put in a staff cost rate and have that set up in function point. A lot of people have the billable rates in there, but not the cost rate. So if you would like to learn more around how to do that, please feel free to reach out to your customer success manager or just email us. Email us at success@functionpoint.com. We'd be happy to help with that.
Yeah, so you guys are lucky if you use a tool that automatically calculates that. For a lot of people, that's not baked in, and so they have to do it by hand, which is painful.
Okay, the next question is from Jackie. Our agency considers billable staff as cost of goods sold, which then makes us unable to calculate AGI the way you do it. What happens then?
I'm sorry, say that again?
Just repeating the question, our agency considers billable staff as cost of goods sold, which then makes us unable to calculate the AGI the way we do it.
Yeah. Sorry, but that's wrong. And the reason why it's wrong is because you pay them a salary, whether they're shopping on eBay or they're on vacation or they are serving a client. They are not a cost of goods. So you can't use any of the metrics I just gave you if you continue to calculate it that way. They are absolutely not a cost of goods. They are a fixed expense. So when we went through the last recession in 2008, a lot of people reduced their staff fixed expense and moved to using more 1099s, variable expense. That's one of the ways you figure out what is a cost of good versus what is a fixed expense or an overhead expense, something that comes out of AGI. So whoever's doing your accounting, and again, this is agency math versus typical accounting. For you, your staff is not a cost of goods, because otherwise, when all your clients stopped giving you money because of COVID, you would have been able to stop giving your employees a salary. Well, we don't get to do that. You were able to tell your 1099s, I don't have work for you, so I'm not giving you money. That's how we know they're a cost of goods, but you can't do that with your staff. So they have to be factored down below the line because their salary comes out of your adjusted gross income.
Okay, thank you, Drew. The next question is from Greg. What are your thoughts on laying off key staff or some great talent versus the ability to get them back when we return to normal?
Yeah, so this is a very challenging time to make those decisions, no doubt about it. But I will tell you that unless you have clients that are saying, I'm ready to sign a purchase authorization, I'm coming back next month or whatever, you've got to manage your staff down to the money that you have. So again, you cannot afford to go in the red because that's when the boat sinks in the storm and you have to get it to calm waters. So normally I am not a fan, for example, of everybody taking a 20% pay cut. It's brutal on morale and all of that. But in this time, in COVID, if you have a choice of I have to lay off some A players, so here's how I would approach that. First, anybody who's a B or a C player, if you can't afford to keep them, let them go. Be kind about it, be humane about it, but lay them off. Now, if you have to actually cut into the muscle of your agency, some of your best players, because you've lost that much business, now you might think about doing a salary reduction across the board. Some agencies are doing everybody over 75,000 or 100,000 is taking a bigger hit than the people who are making less than $50,000. Other agencies are doing just 20% across the board. Right now, I don't think that's as damaging to morale, but what you can't do is you can't stay in the red. So if you cannot figure out a way to keep that superstar employee, you're going to have to furlough them, lay them off, and you can say to them, look, as soon as business comes back, I want you to come back. Or you can ask them to become a 1099 and you can buy bits of their time while you are trying to rebuild the business. But what you can't do, and this is where most agencies, for agencies that end up going out of business because of COVID, it will be based on this decision. It will be that you did not reduce your staff as quickly and deeply as you needed to stay in the black. And I understand, I totally understand how hard and horrible a decision that is, but it is your job to take care of the whole. And sometimes that means that somebody has to pay the price for that. So check your numbers carefully, look at your agency culture to see if they would weather an across the board cut rather than losing your key employee. But it may be something you have to do. And what I don't want you to do is I don't want you to stop taking a paycheck so that you can give someone else a paycheck. That is not good management. You really do need to manage by the numbers, even if the numbers are ugly.
Right. The next question we have is from Jennifer. It's relating to AGI. So in AGI, does COGS mean payroll plus overhead?
No. Gross revenue is your total billings. COGS, cost of goods, or anything that you only purchase because of a client or a project. So media, it might be media software, because why? Because if you didn't have clients you were buying media for, you wouldn't have the software, right? It would be printing, it would be photography, anything that you incur a hard cost, like you pay money out to someone to finish a job for a client, is a cost of goods. So now draw a line. So you take your gross revenue minus your cost of goods, and what's left is your adjusted gross income. And out of your adjusted gross income, you pay for your people, your salaries, so your W-2 people if you're in the US, you pay all their benefits, you pay your overhead expenses, rent, phones, car allowances, whatever that is, professional development, and then hopefully there's profit left over. So cost of goods are basically something that you're paying for that you're going to bill the client for. So the client's paying you for it, but you've already paid for it. So it basically nets out to zero, right? Or it's anything that generates a commission or a markup. So you get to keep the commission or the markup, but the rest of it is just a pass-through cost.
Great. So the next question is from Robin. And just a quick reminder for everyone, in your GoToWebinar control panel, there is a question section. So if you do have any questions, please feel free to take advantage of this and ask them through there. Okay, the next question is from Robin. So PPP requires that we have the same number of employees as before COVID. So understanding cash flow in the next 60 days will be important. Do you agree with keeping those employees on board until the 8 weeks is up?
No. PPP is a couple things. So they're going to be looking at headcount, and they're going to be looking at your payroll number, right, before. And remember, what they're looking at is to decide how much of the loan is forgivable. I think it's very dangerous. If you have enough work for everybody, then fine, keep the same headcount. But if you basically have somebody twiddling their thumbs at home because you don't have enough work for them, I would much rather have you get less of the PPP loan forgiven, and some of it that you're just going to take on as a loan at 1%, which is the cheapest money you're ever going to get, right? So it's okay to have some of that money not be forgiven and still run your business better. So if you really should be down 2 people, keeping those 2 people for 8 weeks, while it absolutely doesn't cost you money because you've got the PPP money, it does cost you opportunity. You could be doing something different with that PPP money. So if you looked at your team and said, these people are all busy, they're all fully deployed or reasonably fully deployed, and I have 8 weeks to try and make up the revenue I've lost. I've got 8 weeks of basically free money to pay them so that I can go out hustling for new business, so that I can sustain them after the 8 weeks, then absolutely keep them. But if you know right now that there is no way that you're going to be able to keep that person for beyond the PPP funds, or they're a marginal player that really you think about their impact on the agency if they come or go isn't that significant, don't let the PPP funds drive the way you run the business. Let the metrics run how you drive your business, okay?
Okay, great. Now I just want to give let everyone know that if you do have reporting questions on how you can pull a lot of these numbers that Drew is referring to, whether it's billable, billability, utilization, the number, profitability, please do feel free to reach out to us or your customer success manager. If you're not sure who your customer success manager is, that you can just email success, SUCCESS @functionpoint.com. So I do have one last question here in regards. Currently the agency tracks all the billable hours. However, they don't track vacation time or non-billable time, such as admin work. What are your suggestions around that?
Yeah, I think you need to track both billable and non-billable time. So it's important for you to understand the whole. So I have this big bucket of hours that I buy from this employee. How are all of those hours being spent? So and again, it doesn't matter if you have unlimited PTO or you have a set amount of PTO time. They should be tracking their time because, for example, let's say I am your employee, and when you look at my billability, I'm at 43%. Then the very next question you're going to ask yourself is, well, what is Drew doing for the other 60 some percent? Well, I need to look at that now, and I need to say, well, okay, here's where he is. He's taking a ton of vacation time, or you know what, his mom has been sick and he's taken a lot of personal time, or I don't know what he's doing, or boy, we keep pulling him into biz dev, and so really we have to think about him as a non-billable employee. So having a full understanding of the time is critical, and it doesn't have to be you don't have to have 9 million function codes for your time. You probably have 8 to 10 in the non-billable category and 8 to 10 in the billable category, and that will give you all the detail that you need. And also on timesheets, it's also important that they note. So it's not just that I record 3/4 of an hour on this job, but I'm writing you someone a little note saying what I did or why it took longer than it was supposed to. Because as you guys know, then as you gather all this data to actually invoice the client, you want to have that diary of commentary from the team. So if a client asks a question about a bill, or you find out that, wow, we were amazingly profitable on this project, and the note says, well, you know what, this creative brief was better than any other, I was able to get right to it. Or vice versa, if you go over a job and someone's saying, well, there was no creative brief, now you can begin to diagnose why you're profitable or not profitable. But without that data, you're guessing, and guessing is not the way to run an agency.
Okay, so we have a couple more questions here. This one's from Tyler. So is it correct that the AGI calculation does not include salary since it's just gross income minus COGS?
Yes. So Yes, AGI, how you spend the AGI is salary. So you have your gross billings minus your cost of goods gives you your AGI. And out of the AGI, that's where salaries sit. So it's salaries, benefits, overhead, and profit. So yes, when you're calculating your AGI, you don't put your salaries up in cost of goods. The only people expense that goes in cost of goods are your 1099s, because your only reason they're working for you is because you have a specific project or task for them to do. And you wouldn't send them money if they weren't doing that task. That's in your head. That's how you separate the two.
Awesome. By the way, Drew, I'm learning so much myself, so thank you for doing this. Few more questions here. So this one is from Beth. Some of your billable people also help with business development. How is the best way to handle this time versus billable time?
Yeah, so what most agencies do is they count that as non-billable time, because it is, you can't bill it to anybody. But then if they land the client, then what they try and do is they try and convert it to billable time. So they're going to say, okay, we spent $10,000 on winning this client. Are there places that we can take some of those hours and apply it to the work, right? So could we put some of it into the discovery process? Could we put it someplace else? So they try and recoup some of that expense. Honestly, if you're running the business well, you don't have to monkey around with that, because you're building your estimates with enough margin of profit that it takes into account the time you spent earning the client. And obviously that's a one-time expense that you don't have to go through year after year. Yes, you're re-earning the business, but not by repitching it probably. So most people absolutely count it as unbillable time and acknowledge that is, so what that also does is, if let's say you have too much unbillable time in your business, what that probably means is you're chasing after too many prospects, and some of them may not be really the right fit for you. So you need to be more judicious about who you chase after, because as we all know, biz dev is expensive. It takes a lot of time and energy out of your team. So you really want to go after the clients that are, again, going to fall at least 10% of your AGI. There's no reason to chase after a bunch that are going to be 1% and 2%. Now, normal times. In COVID times, if you've been really knocked to your knees by clients hitting the pause button, you probably are willing to take projects that are smaller or clients that are smaller than normal. But in best practice is that really you should only be chasing after clients that are at least 10% of your AGI. So if your AGI for the year is $1 million, then really I want you going after clients that are at least $100,000 of AGI for the year.
Great. The next question is from Denise. We do some reporting for clients that also helps sell them on continuing our services, but those jobs and reports are not profitable, but do lead to more management buy-in and ongoing work. How do you address that? As that will throw the percentage of billable time they actually bill, right?
Okay, so I think what you're saying is, we invest a fair amount of time in doing some reporting for clients, but we can't bill them for that time. So what that means is, when you're building your estimates, you've got to bake in, so let's say on an average job, 3 hours is spent doing that reporting that you can't bill the client. Well, you've got to bake that time, that 3 hours, into the estimate. So you've got to put more profit margin into the job to make up for that time, ideally. So otherwise, it's not going to throw off the measurements. It's going to show you the accurate metrics. So it may be that you are willing, because you know that it allows you to upsell the client more projects. You're willing to have a larger amount of unbillable time. But I would have a task code specifically for that reporting, and I would be tracking against it. Like, are we doing that as efficiently, as effectively as possible? How does that relate to the project of the job? So if a project was $30,000, we have more room to do that reporting than a project that was $3,000. So I think that data will allow you to manage how you build out that reporting and how you account for it inside the job. But ideally, so here is I call it the Drew McLellan hack. No agency, not an agency on the planet, is good at estimating. All of you underestimate. So what I recommend in our Money Matters workshop is you do your estimate, you figure out what it is, and then you multiply it by 1.3. And that's the number that you give your client, because that's actually the accurate number. You will be profitable at 1.3. And if you're really lousy at it, do it to 1.5, because that's the accurate number. And I had an agency that was at 2% profitability, and the only thing we did was apply the 1.3 and 1.5 factor to their estimates for 90 days. And in 90 days, they went from 2 or 3% profitability to 14% profitability. We didn't change one other thing. And by the way, the AEs had a cow. They were like, clients aren't going to sign off on it. This is too expensive. In 90 days, and this was a project-based agency, so they pushed a lot of work through in 90 days. In 90 days, one client objected to the new estimate one time. The rest of them signed the project authorization, paid the 1.3 or 1.5 markup, version of the estimate, and the agency became more profitable. So that would be another way for you to factor in that reporting time.
Okay. Great, thank you, Drew. And just to elaborate on that, if you are using function points estimating tool, which I hope you are, it does give you a projected margin percentage as well for you, so you can quickly see. And as long as you have the backend set up with your average cost rate or your staff cost rate, it is going to help you calculate your projected margin, so you can really quickly see what your potential AGI might be. So, all right, a couple. So we have a question from Ryan. If you can just reiterate when to use the 1.5x for estimate versus the 1.3x.
This is going to sound terrible and it's going to sound sexist, but women are better at doing estimates than men as a general rule. You may be the exception to that rule if you're listening. So if a woman is driving the estimate, I would recommend you use 1.3. If a guy is driving the estimate, I would recommend 1.5. I've seen hundreds of data points on this, and it sounds ridiculous, but it's amazingly accurate.
Very interesting.
Yeah.
Okay. All right. I think that is all the questions that we have. We are 4 minutes past the hour, so thank you all. I will keep the GoToWebinar open for another 3-4 minutes, just in case if anyone else had just in case anyone else had additional questions. But yeah, so just a reminder to everyone, we will be sharing a recording of this webinar, and also the slide deck will be emailing it to you, and it will be accessible online so that you can also share it with your colleagues. In the slide deck, you'll see Drew's contact information. So if you do have more in-depth questions, feel free, reach out to AMI and Drew. They do have a ton of resources that's going to really help you, and especially during the COVID-related items. I was enamored with the amount of resource and support they provided. So, but if for any other related questions on how to pull some of these numbers or how you can better utilize function point to generate this, including whether it's 1.3 or 1.5x on your estimates, please feel free to reach out to our success or support team at success@functionpoint.com. Thank you all again for joining. Again, we'll keep it open for another 2-3 minutes in case there are any pending questions. But Drew, lots of thank yous around the room for today.
You bet, my pleasure. And I'm happy to answer your questions. As you might imagine, my inbox is a little full right now, but I promise I will get to you if you shoot me an email. So please feel free to do that.
Awesome.
Keep your agency healthy, you guys. It's as important as it is for us to stay healthy. It is important for you to keep your agency healthy, and that means in the black. So use these metrics to do that. There's no reason why you can't survive this and come out of it strong. So just set your sights on that and make the tough decisions when you have to, and look at these metrics on a consistent basis.
All right. Great. Well, thank you, Drew. I'm going to close off the webinar now. So thank you, everyone, again for attending, and thank you, Drew.
Thanks, everybody.
Have a good day.
My pleasure. All right.
Bye.